Hey there, we're live. We're just getting started. Okay, getting started, making copies. Good to see you. It's Mitch Goldberg. It's 4:30. Well, it's a little past 4:30, but we're getting the show started now. It's that kind of week. But you know what? If we're getting started now, sometimes, just getting started has to be good enough. Couple of things to talk about. Markets down today. We were talking earlier this week that after last week's huge run, best week in like 2 years, are we going to sustain that gain, or was it just a pause from all the selling and the the general downtrend that we've been in is like over? And I think people seem to get caught up overly. People get overly pessimistic or optimistic after really big moves, and that's why I like to just say, calm down, slow your roll. And this is why I don't like big up moves in the market because they get repealed too quickly. The other day we spoke about the kitchen sink on Monday, all the bad things in the market, all the bad things thrown at the market. Yesterday we talked about good things in the market and reasons to be optimistic. So maybe today we'll talk about balance. We could talk about whatever you want, but the best thing to talk about are the answers to the questions that you may have. So if you have any questions, hit me up in the comments. Um, Words of encouragement, words of wisdom, those are always appreciated as well. Um, so let's get the party started. I'm going to roll the introduction. We'll talk about today's somewhat big drop in the market. Um, there's no shock value to today's drop. It's just a generally down day in the market, and then we'll get into the chart of the day. We'll look at how different sectors did. Why is the market down? Is there something to worry about? I can't believe it's already Wednesday, and the weeks are flying by. So far, it's a pretty cold spring outside of the Northeast. Hopefully, it's nicer where you are. Yeah, okay, here's the intro. Here we go. All right, I see some of you out there. Thank you very much for tuning in. We're just getting started. You haven't missed anything. I'm Mitch Goldberg. You're watching my live stream. I call it Be the Boss of Your Money. What it's really about is giving you the knowledge, uh, sharing with you experience, benefits of my experience, the benefit of lessons learned from mistakes that I've made. And I share that with you so that you could be better off financially. I've been doing this for over 30 years in the industry, and I've seen all kinds of success stories, mistakes. I've seen major comebacks, and I've seen major success stories blow up, and some come back, some don't. So I share that with you here. I love talking about the market and stocks and what's going on in the world of finance, the world of politics, uh, the business environment, policies, environmental, you name it. We talk about it here. So let's get into it because there's a couple of things that you need to know. It was a pretty substantial down day today. You know, I think we need to carefully consider what we think is substantial because we've had so much volatility already this year that what we could consider substantial 6, 8 weeks ago is now like kind of blasé and boring. So, is it that investors are becoming more, are becoming uh, shock proof? Is that a good word to use? Are investors becoming shock proof to big ups and downs in the market? There's two things that could be happening, right? Investors are becoming more shock proof to the big ups and downs of the market, or investors are just saying, "I'm done with this. This is a ridiculous place to put my money, and I don't want any part of it. So I'm just going to be happy in the bank earning nothing. And I expect that one of these days interest rates are going higher. So I'll eventually make more money." I could see a lot of people doing that. There is definitely an issue with less liquidity in the markets, and that's one of the reasons why you're getting such big swings in the market. Investors are trying to determine what is the deal with the economy. It makes sense that if we're heading into a recession, The stock market would reflect that in advance. The bond market would reflect that in advance. But it also makes sense that if we're not going into a recession, we're just going to an economic slowdown that will help bring inflation down and still keep unemployment low, then stocks could trade a lot higher. That's called, by the way, the Goldilocks scenario. And the current setup is that the Federal Reserve is trying to engineer a soft landing. So inflation is spiked up a lot and it's persistent, not transient, it's persistent. And a lot of the things that could be solved, like supply chain issues, are taking too long to be solved because there's rising COVID cases all over the world. Again, the new Omicron strain is popping up everywhere, including the United States. China has such a severe uh, reactive policy in terms of shutting down entire cities over Omicron. You obviously have the war in Ukraine. Oil is in short supply or expected to be in short supply. We're not having trouble getting oil as of yet. I mean, if you want to fill up your tank with gas, no problem. You can get it, but it is costing more. But it's not like you've gone to a gas station and there's a big sign that says we are out of regular or, 92 or 93 octane available only. You haven't seen something like that. I have seen signs like that when we had Superstorm Sandy come through Long Island. We actually ran out of gas on Long Island, and it was a pretty freaky thing to see lines of cars that would go like a mile long so people could get gas. It was very, very strange thing. All right, but we'll fast forward. We'll fast forward to today. So here's what you need to know. The Federal Reserve is raising rates. Inflation out of hand. So what's the Fed going to do? Is the Fed I want to shape the question or the Fed policy in very um, up or down terms. Okay, is the Fed more concerned, or is the Fed? Let me say it like this: is the Fed more willing to raise interest rates to tamp down inflation and risk putting the U.S. economy into a recession, versus is the Fed more willing to let inflation keep running away and not do something to hurt the economy by raising interest rates? Which one is it? Because we're living a life of extremes. There's no everyone thinks that the Federal Reserve, everyone thinks that the Federal Reserve could thread the needle and engineer a soft landing where we bring down inflation without hurting employment, without hurting the economy, without hurting the stock market, without hurting the housing market. And I don't think it's really well. It's unlikely that the Fed could do it. It's just inflation is really high, and to tamp that down, you have to jack up interest rates. I mean, if inflation is 7-8% and the 10-year yield is only 2.4% on the 10-year treasury, there's a big disconnect there. So if the Fed is hawkish and raising rates to slow down inflation, it has to slow down the economy. That's how you slow down inflation. You stop people from buying things. You make it more expensive to be a consumer. You make it more expensive for businesses to reinvest in their business. Okay. And that slows the economy. If you overdo it, the economy goes into a recession. But if you let inflation keep running away, that is also very bad for the economy. And that could send the economy into a recession. But in that case, it's even harder to get out. It's harder to get out of that. So runaway inflation is a big worry. And the Federal Reserve has basically said this week, we're worried about inflation. It's too high, and we will do whatever it takes to bring it down. This is why people are saying the Fed's very hawkish, meaning the Fed is very weary of inflation and it's willing to do what it needs to do to knock inflation down. Okay. Question coming in: why should we trust the Fed when they repeatedly get it very wrong? Well, they don't always get it very wrong. They have gotten it wrong a lot, and there are natural ebbs and flows and cycles in the economy for sure. But we have had periods like the '90s, like 2009, 2010 to 2019, where the Fed looks like they got it right. Now, I don't know if you're willing to give the Fed credit for the smooth times when inflation is low, the market's going up, the economy is piping along at a pretty good clip without generating inflation and still keeping unemployment low. We, we we could ascribe that to a lot of things. There's technology for one thing, uh, globalism, global trade, keeping prices down, keeping the cost of labor down. But in this case, I find it very difficult to trust the Fed, which has printed so much money and helped get us into this mess. Now, I've been saying consistently, I applaud the Fed. I think the Fed did what they needed to do, and then it went too far. And for months last year, everybody was saying the Fed should already stop buying Treasury securities and mortgage-backed securities to pump more liquidity in the market. They should have done that a long time ago. Now they're behind the eight ball. The Fed only stopped buying bonds this month, and now they have to jack up interest rates, and it's I think it's going to hurt. Raising rates, raising the cost of money, which means the cost of everything goes up, could be could be a problem. Uh, you could say it will be a problem, but I have to say, being in a live stream in the public forum, I have to say things like could, should, or might, or may, as opposed to will. Okay, so take that with a grain of salt. All right, so you don't have to trust the Fed. I think that's the problem right now with the bond market and with the stock market, is that people don't trust that the Fed is going to guide us into a soft landing. So would we be, some people say we're better off without even having a Fed. Just let the market, the invisible hand of the market, let that control and determine everything. Tough to say. When things are working out well, we love the Federal Reserve. When things are not working out well, we hate the Federal Reserve. It's tough to have it both ways. I do believe in an impartial Federal Reserve that is not influenced by politics. All right, so let's take a look at how things did. I'm going to make my screen a little bigger before I put y'all on it, and we'll take a look at the end of the day wrap up. Here we go. All right, I'm up here in the corner. Hey, so the Dow down about 450, Nasdaq down 186, so over 1.3%. S&P down almost 1.25%. Gold was up. That's a flight to safety. Oil was up over $5, up 4%, almost 5%. The 10-year yield backed off at the end of the day down to 2.29% after hitting 2.4% plus earlier in the day. The VIX popped up a drop. It's up to 2357, and it seems like it's getting stuck. So we've been talking about seeing that go from 35 to under 25. We need to see under 20. If we don't get it, I think we continue to be volatile with a general down trend. Let's take a look at some of the cryptos out there. All right, so cryptos are holding up pretty good. Bitcoin holding up okay. Recently President Biden said let's explore a framework for crypto in the United States, and I think that overall is pretty bullish. And I think people prefer to have some kind of framework and regulatory guidance for the trading of crypto. People believe that would actually bring more people into the crypto market because the market would have more trust in it. Okay, Ethereum's still under 3,000, and let's look at the Doge. The Doge 13 cents. That was like 25 cents for so long, then 20, now 13. It's up a whole penny today, and it was started as a joke, and I know Elon Musk touts it, but you've got to be careful when you buy or sell something based on a media personality touting something. All right. So let's take a look at the chart of the day. GameStop. GameStop. I did not mean to hit that, but let's just go to year to date. GameStop started the year, so let's say about 152. So let's call it 152, and now it's 138. Still down on the year, but look how much the stock has come up. Look at that. Look at that chart. That's because the new CEO who came over from Chewy um, purchased 10,000 shares. Let's look at the month chart and see what that looks like. Okay, the CEO bought 10,000 shares, sending the stock up. People are still trying to figure out what their game plan is. I recently made a meme um, of the stock saying it would have to go up like 600% to get back to its old high. This is going back about 2 weeks ago, and it's 138. It was down to the under 100 obviously recently. A stock like this can have big swings, and I've always said that these stocks could be good trades, but don't mix them up with good investments. You could always get a tradable bounce. But that is one hell of a move on GameStop. So from about 80 to almost 140, 60-point move. That is a pretty big move. We would all love to be in a stock like that. So why don't you recommend those stocks, Mitch? You may be asking. I don't recommend those stocks because I really don't like to gamble with other people's money. These companies have no fundamental reason to be in business unless GameStop has something so dramatic up its sleeve. But I don't know if you saw not too long ago, for example, Microsoft purchased Activision Blizzard. They're in the process of purchasing Activision. They made a takeover bid for them, for that company. That's how people get their games. They get their games online. They play on servers. They play in the cloud. I know this because my kids are big time gamers. And it's hard to see what a GameStop store offers anyone, including consumers. Have you ever been to a GameStop? I haven't been to a GameStop in years, but I just don't really see the reason why these things are still in business. So that's why I pan the idea of competing with online streaming. Okay, um, go check out my Discord channel. No, I'm kidding. I don't have a Discord channel. My son has a Discord channel. Anyway, let's see the winners of the day. XLE Energy, the winner of the day. You could tell because oil went up today. Even though XLE went up 1.72%, the cost of oil was up almost 5% today. So energy stocks didn't quite move in an amount that's commensurate with the price of oil. Utilities barely moved. I think utilities went up today is more of like a flight to safety thing, but the XLE was up 10 cents. Losers on the day, financials, which oddly enough were the winners of the day yesterday when rates went up. Today, long-term rates backed off a little bit. So this is what it's going to be like when long-term rates go up. When long-term rates go up, you're going to see banks do well, and when long-term rates go down, you'll see banks do poorly. And it all has to do with the spread between the short-term rates and the long-term rates. So if long-term rates go up, the spread here gets bigger. Long-term rates go down, the spread gets smaller. We like big spreads for financials for now. All right. So that is pretty much what's going on in stock market land. Got a couple of ideas to bring to the show that's going to take a little bit of research. All right. So we talked about a couple of things. We talked about yesterday about mortgage rates going up a lot. We talked about spending, housing, and I think it's important to follow the stock of Home Depot. So let's just get a quote on Home Depot, kind of give us an idea of where investors think the housing market is going to go. All right. Home Depot was up to 420. It's 317. It was down. Wow, it was down over $12 today. I think as goes Home Depot, that is your tell for the housing market. I think Home Depot will give you an early tell on the housing and the mortgage market. By the way, mortgage applications for refinances are plunging, and they're also dropping pretty significantly for new home purchases or first-time home buying of existing homes. Those applications are plunging too. Got a lot to worry about. We still have some good things though. Also, yields are still low. The economy is still growing. Companies are flush with cash. We've got buybacks coming through. Things aren't all bad, but you're just going to have to get used to this crazy volatility. And hopefully, this doesn't chase you out of the market and you sell when everything's down and then you miss the returns and everything's up. This too shall pass, and then we'll have a whole other calamity to worry about. All right. Thanks so much for watching. I will see you guys tomorrow and wish you all a good Wednesday night. Bye bye.